Hey friends, welcome back to the monthly report. And so this is a little bit of an extended report compared to our 2 to 3 minute monthly report that we're doing for folks. We hope you enjoy this. And again, as always, if you have questions that you'd like us to expand on, we're always happy to add them to our Asking for a Friend section. But stay tuned monthly for these reports, and we hope you enjoy them. I want to dive in, as I mentioned in the 2 minute report. This is overall of the stock market performance that's happened so far. This is specifically the S&P 500, and despite the bear market this year, the market has rallied significantly in the past 2 years, and certainly even in the past few months compared to where we were at the very bottom of the market, which is often what happens, right? Markets continue to remain uncertain due to inflation. We're hoping to get some additional information about where things are coming in here relatively soon. And we believe that, this is a new launching point as we've seen in the past. You can see over the last couple of decades, right? This is since 1995. The stock market has fallen into bear market territory, and I guess it was Q2 that happened, and has now rebounded somewhat from that period of time. And you can see that in the chart there towards the end, it has actually rebounded. We believe in the long run, the markets will continue to go up because obviously there's going to be economic growth after we come out of this current cycle. We have no idea if we're actually going to head into a recession or just a slowdown in this particular cycle. One of the things that's really interesting to me, I always watch this, and I've told the team this many times, they're probably sick of hearing it at this point in time, but there's two types of trading that takes place. One is fundamental and one is technical. And the fundamental is more about the companies and their fundamental earnings, growth, all that sort of thing. And then on the technical side, there's moving day averages. Well, there's lots of other technicals as well, but one of the things that I look at is the 50, 100, and 200-day moving average. You'll notice on this chart that there is an uptick, especially in the 50-day moving average. And you'll also notice that there appears to be an intersection between the 50 and 100-day. That could be a technical buy signal. If you look at some of the other intersections, you'll notice that the markets tend to follow the trend of whatever the technical is in the short term anyways. So for me, I'm wondering if we're about to see even if it's a secular recovery here, if we're about to see a situation take place again where the markets are ready to possibly recover a little bit more from the loss that we have experienced this year. When it comes to stock market price to earnings ratio, this is another area that I'm most interested in because you can see that the historical average has been about 15.5 times earnings, price to earnings. So right now we're at about 16.8. So we're still a little overpriced on the averages. Now that's, not to say that that's going to be a bad thing. It's just that is something that we anticipate will probably change, and should we head into a recession or a slowdown in the economy, we could see that move more in line or decline a bit more, just to come back in line. So again, something to keep an eye on. This is another chart that I really like to show clients, and just to sort of keep things in perspective. I mentioned earlier that we were down about 24% earlier this year. It's actually we're actually about 13 to 14% in recovery at this point in time. So when you look at the red dots, why this is interesting to me and why I like to share it, the red dots are the maximum drawdowns in any particular year where, it's showing that basically all markets, all years have a period of time where there is a decline. So that's the maximum drawdown. So even in years where we've ended up, there have been periods where the market has been down within that given year. That's the volatility of it. So if you look at, for example, 2009, I like to show that particular year because that's a big year of recovery. the market was down at one point in time in 2009. Well, 2008, the year before, it was down 49%, ended down 38% in total. Then the very next year in 2009, the market was down 28% at one point in time. And then March 9th being the recovery date of 2009, I mean, that's when they say is when the recovery started. Actually, the year ended up 23%. So when you look at that big swing year over year, that's what the markets can do. And that's why we say to folks, like, stay invested, because we don't know how quickly things are going to recover. Even as close by as 2020, you see that the red dot is down 34%. That's actually more than what we've been down so far this year. Although I know a lot of people don't feel that way. This has been a more extended period of time, but I like to particularly show that chart because I think that it helps people digest what we're going through right now. Now, this is on a total return basis. So this is taking into consideration dividends being reinvested. And you can see this is where the 23 versus 13% that I was talking about earlier. So they're really basically the same thing, just one is with dividends and one is without. And again, I mentioned this in the 2-minute video. I like to show this chart because this talks about market corrections and recoveries. The S&P 500 total return since World War II shows that declines of 10 to 20%. The bold line is the average across all corrections and all recoveries. And the market on average falls about 14%. As I mentioned earlier, we've actually fallen closer to 24 this year, 23 if you take into consideration the dividends. It did take about 6 months for that to happen. We are not, in my opinion, into that average recovery period yet, but that's just my opinion. I do think that probably sometime in 2023 we'll start to see that. But that average recovery is about 4 months. And then we talk about bear markets and recovery. So that's 20% decline or worse. The average bear market, as you can see on this chart, it was around 34, almost 35%. And the total recovery from that on average has taken 2 years and 5 months. So that's the recovery from the crash, from the peak to the trough to the actual peak again, peak of where it was before. Now, the most recent was only about 6 months, and that was the 2020 recession or bear market. But that was, again, I think an outlier for these averages. We also like to show this report because it talks about the importance of staying invested. And if you miss some of the best days of the market, I really love to walk through this with people and talk about why it's so important to stay invested, because even just one day makes a difference of, over $300. Kind of switching gears and talking a little bit about interest rates. I know a lot of people have asked me about what they're hearing about this inverted yield curve. As you can see, it's narrowing a little bit, but the 2-year is still a better rate than the 10-year, and that's why we're keeping durations very short in nature, because we don't feel that there's any advantage to going out long especially on the rate side, right? So if I can get a 2-year CD right now at 3.5, or a 2-year bond yield of 3.58, but if I do a 10-year bond, I'm only getting 3.37. It doesn't make sense for me to go out. There's risk in my money not keeping up with other yields in the future. So we're keeping it pretty short in duration, knowing that the Fed is going to continue to raise, or likely going to continue to raise interest rates. As interest rates get higher and we start to see this yield curve get closer to the norm, then we'll switch out our longevity future. Looking at historical GDP components, as you'll see, today we're down about 4%. The pre-2008 period of time was about -5%, and when we look at about 20 years ago, we're looking at about a 1% GDP component. And this is not probably as important to many people as it is to us, just looking at what the economy is going to do. Speeding down through some of the leading indicators that are out there right now. We think that the confidence board, the leading indicator year-over-year percentage change recessions, are shaded This chart shows the year-over-year percentage of indicators, and indicators usually turn negative 7 months before a recession is about to happen. So that's what we're looking at it. We've also noticed that consumer spending on non-stores has has not modified as much as we would want, and we're going to keep an eye on some of this, and retail sales. Building permits have definitely slowed. That is a sign. I think that's certainly a point of inflation. Existing home sales have definitely slowed, as you can see. And I think that's an inflationary issue. And as I showed in the 2-minute video, you'll see where the balanced portfolios actually perform compared to the other. Major currencies is something we're keeping an eye on. You can see the dollar is the strongest it has been in many, many, many years. If you're thinking about traveling, now is a great time for. We hope you have enjoyed this 10-minute version of the monthly market summary. If you have any questions, concerns, or would like us to explain anything more, please reach out.